in the beginning of the battery boom, it was that people would focus on a single market, like frequency control, for example, because there were good revenues in the last few years. And it kind of worked in France and Germany because they were relatively larger markets with sort of 500 megawatts of capacity needed on a daily basis.
Would you say that this voluntarily curtailment of renewable assets, could you call that a first strong sign of success of the market?
In general, markets are quite well able to regulate themselves. It's controversial to switch off renewables while you still have fossil fuel assets running, but it's just the cheapest option.
How does such a typical investment case look like for a 350 megawatt 4-hour battery? What types of analysis goes into it to say yay or nay?
We do quite a lot of these projects as consultancy as well. You have a project developer and they're starting to look for, well, first for location, which can be quite challenging in some countries. Then they get the permitting and they start the whole process, which we are generally not involved because
Jean-Paul Harreman. Welcome, Jean-Paul.
Hi. Yeah, thanks for having me.
Could you give a short introduction?
So I've been in the market since about 2001, but I've joined EnAppSys in 2016 when we were still a small analytics firm based in Stockton-on-Tees in the UK. And basically I set up the European short-term power trading analysis. So for power traders, non-physical traders, and asset optimizers. We first started in Netherlands, then Belgium, and now basically we cover 33 countries across Europe. Very much into short-term, intraday balancing markets, those kinds of things. And then 3 years ago we were bought by Montel, so we're now part of the happy Montel family, which means people will know us from the free beer at the eWorld stand, where actually we had some very nice visitors from Time2Market this year. So yeah, that's in short my role. So things changed a little bit after we were acquired by Montel. So I'm basically now responsible for the short-term product, which is still called EnAppSys even in the Montel group.
Thank you, Jean-Paul. And just to clarify towards our audience, when you say short-term, can you just walk us through what is a short-term definition for you?
Yes. It's so our main focus is from, let's say, bidding for ancillary services, so D-2, D-1 sort of, and then all the way up to gate closure of the intraday markets, the balancing markets, and even post trading. In some markets that's also possible. So it's really from, let's say, very vague timelines from a week ahead, but from 3 days ahead, that's where our sweet spot sort of starts, and where we do things a bit differently than other companies.
So that's where your personal experience lies, and also where the EnAppSys Montel data suite basically provides the core expertise. Yeah. Let's look a bit at these markets, the short-term markets, hours up to days ahead, so to say. Can you walk us through some of the recent power market behaviors we have seen in Europe? What really stood out over the last few months?
Yeah, well, I mean, there's a lot of changes going on in short term. So we see changes to quarter hourly granularity on the day ahead market. We see changes on balancing. We see the launch of PICASSO in different countries with all the nice artifacts of harmonization. You do hear a lot of people talking about batteries, but I think what stood out for me in the last year is that the market is struggling with flexibility, and as a market, we're actually seeing periods of oversupply and undersupply, and we see interesting developments, especially around renewables. So renewables are starting to contribute to flexibility markets, whether it be intraday, whether it be balancing, or even ancillary services in some countries. And renewable curtailment is something that really stood out for me in the last year. It was amazing to see the volumes increase to such levels. And it looks like this is going to be sort of the magic toolbox to keep the lights on for the next few years.
And
so
you
that's something I didn't hear a lot from in the media. So that's why we started writing about it, because I think it's an important artifact of what we're seeing in the market.
Yeah. And we are, of course, very familiar with these terms as the renewable curtailment, flexibility, but can we try to zoom out to explain it more towards an outsider? What does this flexibility mean? On what type of time scale do we apply it? What types of assets are behind this flexibility? Can you walk us through?
Yeah, no, definitely. So basically what we're seeing is a growth of renewables, and especially during solar peak, but also during very windy periods, we're facing surpluses in power generation. Normally you would say, well, okay, then we switch off the fossil fuel generation, but actually we need fossil fuel generation for stability and for balancing purposes. So we can't really switch that off, which means we're left with a surplus. And this surplus is driving prices down. So this is one of the causes we have negative day-ahead prices, for example. But it's also causing all other kinds of issues. And in a lot of markets, we're seeing the grid operators dispatching assets down. So wind farms, solar farms, doing redispatch, so basically dispatching down solar or wind in one part of the country and then fossil fuels upwards. And what I find very intriguing in the last year is that we see renewable assets voluntarily switching off. And they do it at negative prices, which means they wouldn't receive a subsidy if they would run. The revenues would be low anyway. And unsubsidized renewables would definitely switch off at negative prices. We're also starting to see it at slightly positive prices, which is amazing, and it's adding a lot of flexibility to the power balance in real time. And it's a very interesting development. The good thing is, if a grid operator dispatches assets down, it's usually costly for the grid, and eventually the bill is paid by the end consumer. Whereas if renewable operators decide not to run voluntarily, the problem doesn't even occur. So it's a very economical way of adding flexibility to the grid.
And would you say that this voluntarily curtailment of renewable assets, could you call that a first strong sign of success of the market, that we are going towards a regime where indeed the market can take care of itself economically and stability?
I think in general, markets are quite well able to regulate themselves as long as you leave them alone enough. Of course, it's controversial to switch off renewables while you still have fossil fuel assets running, but it's just the cheapest option. And so, since there's no marginal cost and there's no starting costs of those renewable assets, it's very easy just to switch them off and solve the issue that way. I think in the longer term, we will see, this is also signaling a need for additional flex. So for storage, for time shifting of demand. If we're able to shift demand to periods where there's a lot of renewable energy, then of course the problem gets smaller, and we don't have to switch off the renewables anymore. If we can store the energy, then it can just generate when the sun is shining or when the wind's blowing, and then we consume it at another time. But in the meantime, as the market hasn't solved this issue completely, it's found another solution to deal with the excesses. That's, yeah, makes it super interesting.
What type of role do the current negative prices play in all this? Do we need these heavy, extreme price spikes for the right flex investments?
So what's interesting is that you see the severity of negative prices decrease. And that is an artifact of renewables basically switching off when the price hits zero. So in the past, they would bid in to the day-ahead market at any price, which basically means minus 500 euros. So pay 500 euros to generate. Nowadays, we see this boundary at 0 or at €1 or at minus €1, somewhere around that, depending on the country and the type of asset. Basically, see this as the new bottom level. Prices do go further negative than -1. And when do they do that? That's when you reach the end of the dispatchable generation. And when renewables or other must-run like nuclear can't dispatch down any further, that's where you need storage. And that's probably also where you find the new sort of floor levels of negative prices. And those are definitely an incentive to invest in storage. Yeah.
So the current severity of price spikes is still high enough that parties want to move into the batteries?
Yes. I mean, it's not easy to get a battery financed. And I think that's good because you don't want this market to overheat. So it's definitely challenging to get a large battery project financed, and we do see examples of that, of financial close being achieved. So recently we had a project of 350 megawatts, a 4-hour storage in the Netherlands that got financed. A brilliant project. The only reason it works is because people stack values across different revenue sources. Just the day-ahead price spread is not enough to create a viable business case. You do need to trade around your battery, optimize, rehedge, sometimes sell the battery 5 times, buy it back 4 times, and then run it to get enough revenue. And then on top of that, there's additional revenue sources like ancillary services, capacity fees, all kinds of different revenue sources. And when you stack those up across multiple markets, then you get a viable business case. One of the problems is, though, that not all markets actually publish price information. And that means that often you have a business case that's either slightly negative or just break even, but then there's the upside of additional revenue sources that can't be quantified. And then it's the question of, do you have a really good project developer that's able to convince the bank that they can actually make this work?
And I would like to just take a few moments here and zoom in a bit more on this business case. You have, of course, all the expertise on the physical spot power markets. You have your whole EnAppSys data suite where you also have services and pricing and data on this topic. Just tell me if it is not your home ground, but can you walk us through how does such a typical investment case look like for a 350 megawatt 4-hour battery? Who is involved? Who are the counterparties? What types of analysis goes into it to say yay or nay?
Yeah, so we do quite a lot of these projects as consultancy as well. So we've done over 100 for Netherlands and Belgium over the past 2-3 years. And basically, you have a project developer, and they're starting to look for, well, first for location, which can be quite challenging in some countries. Then they get the permitting and they start the whole process, which we are generally not involved because we just focus on revenues. You have the selection of the battery and the supplier, etc. Once they have that, basically what we do is we run a simulation of the market on the long term, where you get an idea of the day ahead prices and the spreads, also the sensitivities. How does the fuel mix evolve over time? So what's the competition? Is there enough flexibility in the market? If there isn't, how long will it last? What do we expect in terms of additional batteries coming online? Because we've seen renewable cannibalization, of course, for batteries or any other asset type. Cannibalization is a real risk, where people just enter the same market with a lot of capacity and then basically water down the revenues. We run a simulation of the market. We get day ahead prices, and then we overlay algorithms to find out, okay, the combination of renewables, flexibility, longer term development of that. How much volatility does that give on intraday, on balancing markets? What's the potential revenue on ancillary services markets? And then you run that through several scenarios, and that gives you a revenue projection and also a distribution of the revenues. That's the base, the base analysis that you do. And if you look at the costs and revenues, does that make a positive business case, even with the sensitivities? You could say you have a case to build. With a lot of markets, there's also things like problems with getting grid connections. So there's time-dependent transmission rights. There is time-dependent transmission costs. There's all kinds of other factors that play a role. Being co-located with a solar farm or a wind farm, or being behind the meter of an industrial site. So there's a lot of parameters that you actually need to keep track of. And we kind of built services around that, where people can run their own simulations nowadays. And that's really cool, because now you can see the market starting to mature and exploring its own options. So that's a very nice way of dealing with this.
And do you also take into account the potential higher amount of realized assets in these markets? Looking at your case, if you've done over 100 projects, you're talking definitely a few gigawatts of capacity already. When you put it all on the market, the business case might change a lot. How do you tackle that challenge?
No, so the amount of storage that gets developed is a factor in the simulations. So we basically run the assets in a similar way. And one thing we do expect is that people behave rationally. So what we saw in the beginning of the battery boom was that people would focus on a single market, like frequency control, for example, because there were good revenues in the last few years. And it kind of worked in France and Germany, because they were relatively larger markets with sort of 500 megawatts of capacity needed on a daily basis. But if you do the same in Belgium, for example, so we ran a simulation for a battery of 25 megawatts, but Belgium actually has 24 megawatts of frequency control that it has to contract locally. So basically, with that asset, you'd be the market and more. And then, any historic price that you would use for your analysis would obviously be completely useless. So it's very important to see what kind of markets do you enter, how big are those markets, what is your potential market share, and what's the risk you start disrupting the price formation in that market, because you will have to move to another market if the price collapses. And if you compare battery storage to renewables, so renewables basically make their money on producing power, and nowadays they start providing a little bit of flexibility, but that's limited because of your uncertainty with forecasts. With a battery, generally you have sort of 10 to 15 markets where you can be active. And that means that you have a lot of different options to optimize your revenue. And in the end, where saturation of the market in renewables basically reduces the revenues to a certain level, we would say that the value of flexibility would probably converge to sort of a consensus level of where it doesn't really matter in which market you're active. So
when is that consensus level reached, do you think, or based on the output of your models? Are we talking a few years ahead, a few decades ahead? What is it that you see?
Yeah, well, I mean, it's difficult to say, and whatever simulation you run is going to be wrong anyway in the end. So what we do is we try to make educated guesses and substantiate those with numbers. You sort of see mid 2030s, you sort of see the value of ancillary services and day ahead markets sort of converge into a range of prices where you could say this is pretty similar. Also, if you account like the option value, so day ahead, you basically lock in your price. If you go intraday, you're prepared to have a bit more risk because the volatility is a bit bigger. So it's sort of a trade-off, but yeah, it's very comparable. But it all depends. I mean, if we get a boom in data centers in the next 2-3 years, then that point shifts backwards. If we get scarcity in gas markets, so the gas price is actually one of the key drivers in battery revenues. If we get a very high gas price for a few years, then that point also shifts backward because a lot more revenue to share.
And when we look back in time, let's say the period 2015 to 2020, I think that was really the 5 years where we saw this whole wave of negative prices being introduced, specifically in the Netherlands, where we had the huge amount of rooftop solar basically causing these prices. Then we have had these negative prices for another 5-6 years for sure. Could you say that all these assumptions that we're having now about negative prices are just wrong? As you said, our forecasts, our expectations might be just wrong or will be wrong, and that we will have a lot less negative prices already within a few years?
Well, it depends. So the main reasons we have negative prices are twofold. So on the one hand, yes, we did see this explosive growth in renewables, and very little development in flexibility. On the other hand, after COVID, we also didn't see demand recover in the way we had expected it to recover. And demand is a major factor in those negative prices, because if the demand isn't there and you do have the generation, then you get the surplus. And if there's surplus that's non-dispatchable, and you can't shift your demand to those periods, that results in negative prices. Whatever midterm or long-term forecast you make is wrong to a degree. I think we saw with solar development how there's a very famous chart by the IEA where they show the previous forecast of solar development, and it's always like massively wrong. That potential is there, definitely. But what you do expect is people to behave a bit more rationally when they develop storage, because it's a lot more capital intensive than wind and solar at the moment. So
and you mentioned earlier that all types of strategies are being utilized, from day-ahead intraday spread, frequency control reserves, or even hedging. Would you say that the more, let's call it asset-backed speculation on the curve, is a significant part of these value streams, or just fractional? Because people always think batteries, spot, very short term. Would parties be active on the curve with these batteries, and how much does it drive the P&L?
Yeah, if you're talking about the curve as in weeks, months, no.
Yes, yeah, that curve. Yeah.
That's definitely not a factor
Not at all.
because the storage levels are too low, and so yeah. No, it's mostly on day ahead intraday versus imbalance in some markets where that's allowed. Because yeah, if you can only store about 4 hours of energy, it doesn't help you to shift your load on the forward, but it does help you to optimize over, say, a group of 3 days or so.
Yeah.
So that
So the
that
hedging
definitely.
remains ultra short term.
Yes, yes.
Yeah.
Although we do see um, sort of an emerging interest in longer term duration storage. But yeah, if you look at the price spreads between a summer and a winter power price, yeah, they're not even close to what you can see on day ahead versus intraday the high-low spreads. And that means that if you develop long duration storage, you will have to have either a very, very low capital cost, or yeah, you have to find a sort of a disruptive business model to make it work for now.
And when the chat we had so far was all rather general, not so much localized. Can we zoom in a bit about how are these markets different within Holland, Belgium, France, Germany? You talked, of course, about the size of the reserve markets, but how are the negative prices, or how is curtailment behaving in, let's say, Germany, France, Holland? What do you see there?
Yeah. Yeah, so Germany, France, Netherlands are markets where we see a lot of price sensitive, so voluntary curtailment on a day ahead level. So you could say they're relatively similar, although I would say Germany is probably the most mature market. I think we've seen negative prices in Germany since the 2010s already, whereas France, Netherlands sort of started around 2020, seeing the first negative prices. Yeah, what's interesting is the difference in subsidy regimes. And so,
That was
so we're
just about
starting.
my next question. So I'm happy you touched that topic already.
Yeah. So we're seeing subsidy regimes started with, yeah, okay, we subsidize all renewables. Then they started limiting, saying, okay, well, if we have 6 consecutive hours of negative prices, then we stop subsidizing. Then we got to 1 hour, and now it's basically in a lot of countries, it's okay. Well, as soon as we see a negative day ahead price, there's no subsidy. Um, in in Germany, we've seen this for a while, and yeah, we see this curtailment of solar and wind during negative prices, and the scale at which we see this is massive. So we sometimes see a volume of 20 gigawatts of power, which is, yeah, Germany, I think, is 55 gigawatts of demand. So yeah, 20 gigawatts is massive. And that's being curtailed on the day ahead. So that basically means solar and wind not being produced, the demand is filled with something else. And in Germany, in general, there'll be there'll be imports coming from either France, where it's nuclear, or Netherlands, where it's solar, or elsewhere. If you look at France, France has a big problem with flexibility because they have a system that's dominated with nuclear, and you see them often ramping down the nuclear to fit around demand. So this has been happening, yeah, for ages. But now with growing renewables, these dips are becoming more and more pronounced. So sometimes you see 12 gigawatts of nuclear being ramped down during the solar peak. And the ramping down is relatively quick, but it takes a while for them to ramp back up. And And it doesn't help to eliminate all of the negative prices yet. So basically, you still see solar and wind shutting down when the prices go negative, and this gives a lot of shocks to the system. And in France, the regime is quite strict. So yeah, you see solar and wind being switched off on the dot. So if 1 o'clock the price turns negative, 1 o'clock on the dot, you see solar, wind, boom, switch off. And this gives a shock to the system. So it's affecting frequency, it's affecting the balancing market. And these shocks can be up to 4 or 5 gigawatts in an instant. And if you look at the size of reserve markets, France doesn't have a very large market for fast reserve. So in those instances, you get pretty extreme behavior on balancing markets. And then when the solar peak is done for the evening, the nukes come back, but there's very little room for fast responding flexibility. So there's a bit of pumped storage in France as well as in Germany. But if you look at gas generation, for example, during the summer, you hardly see any gas generation in France. So a lot of the flexibility comes either from abroad or from renewables or from nuclear, but that's not very fast. So it's an interesting market. And the Netherlands is a bit in the middle. So they do have gas, they don't have pump storage. They export a lot of excess renewables to other countries. So it's very interesting how those markets work. If I can get another example of that, maybe Spain. So in Spain, of course, we had a blackout last year. It wasn't specifically caused by renewables, but what we did see is that before the blackout, the Spanish TSO, the grid operator, was running the system at about 70% non-synchronous generation. So non-synchronous generation is wind, solar, but also, for example, DC interconnectors. So interconnectors that have these transformer stations at each side. So like you would have between UK and Europe, for example. So about 70% of that would power Spain before the blackout. And that's quite like borderline in terms of system security if you don't take any other measures. And then we had a blackout, and then from the day after the power got back, they ran the system at only 50% non-synchronous generation. So even though they deny it was, it caused the issue, they do recognize that having a bit more inertia in the system, so a bit more spinning turbines, adds to system stability. But that also means that in Spain, on the day ahead, you see renewables being curtailed also by the grid operator. So that's another story, and there it's not just price sensitive; it's also related to system stability. And you see that in other island systems like Ireland and the UK as well, where the TSO is more active in sort of managing their exposure and managing the frequency stability.
And then back to the topic of the example of France, it is RTE, the TSO, that makes these decisions. So your example of the 1 o'clock drop suddenly overshooting, that is basically caused by the TSO, correct? No?
No. These are the operators themselves that just switch off when the price goes negative.
Okay. So it's a voluntarily market player based event.
Yeah. And the problem is that it's so fast. So RTE has already complained last summer about these shocks and is looking for ways to mitigate the impact of them. And we see in Netherlands, for example, there are restrictions on ramp rates of assets. So you can't do more than 20% per minute if you called for a balancing action, for example. Something like that could help, although if you have a lot of assets, it doesn't really move the dial to a degree that it would increase stability. But it's a super interesting phenomenon, and we expect it to get a bit worse this summer. So it's going to be interesting to see how that evolves.
And what is your driver of that belief that it will get worse?
Because I mean, there's a bit more flexibility in the market, but France is really catching up in terms of renewable development. So there's more wind, there's more solar, and demand hasn't recovered. So yeah, the accesses will get a bit bigger this year.
So you basically say that the speed of development and the delivery of extra production capacity, renewable capacity, year over year is still a lot faster than the answer of the demand or the flex that could balance it.
Yeah. So the only way to deal with that is to make the renewables flexible. But yeah, if you look at reserve markets, so I think Germany has the largest reserve market, which has about let's say 500 megawatts of frequency control, then about 2,000 megawatts of AFRR, so automatic frequency restoration, and then about what's that, 600, 800 megawatts of manual frequency restoration. So it's 3,000, let's say 3,500 megawatts of flex. It does mean as a grid operator, you have to watch what's happening on those wind and solar curtailments, because if you get a drop of 4 or 5 gigawatts and you only have about 3.5 gigawatts of reserves, you might have to rethink how you dimension those reserves. And for Germany, I think it's okay. For France, it's a bit tighter, I would say.
Because if you look at the amount of solar and wind production on a very sunny day with low demand, you don't need that much deviations to run through your full stack of assets, basically.
Exactly. Yeah. And then there's I'm just going to make this a bit worse. I mean, it's let's ruin people's good night's sleep. There's also an island which is no longer part of the EU called Britain. And there are some interconnectors linking into France, into Belgium, into Netherlands, into Denmark. And those are large capacities. And what we see is when the UK grid operator runs out of options, they start reversing the flows on the interconnector sometimes. So they go from imports to exports, for example. But if you look at the amount of gigawatts of imports and exports that are flowing into or out of the UK, there's 3 gigawatts into France, 1 in Belgium, 1 in Netherlands, 1.4 to Denmark. There's also a cable to Norway. If you go from 1 gigawatt of export and then flip it around to 1 gigawatt of import, that's 2 gigawatts of difference. So that's also quite a large shock that you can observe, and it does give challenge of just gives massive challenges to grid operators also on the continent.
And that was going to be my next question. If national grid issues this need, I think you refer to the Faraday platform, where the traders, of course, can obtain their rights, so to say, as long as they have the capacity on the interconnectors. But are such mechanisms available on the mainland? Because maybe RTE or an Elia or a TenneT is not so happy to see suddenly these enormous push and pulls on their interconnector also affecting their frequency.
Assets behind that. If National Grid would have contracted, I don't know, a French power plant to submit the power, and then if they reverse the interconnector, then that plant would ramp. The problem is, UK is one of the countries that has this capacity mechanism. So rewarding assets for being available during tight periods. And interconnectors were part of that capacity auction. The problem is an interconnector doesn't produce anything themselves; they just transport.
Yeah.
So if you have a physical party on the interconnector, like doing the physical actions and making sure the balance is maintained, that's not really a problem. The problem occurs when there's no physical action attached to it. So, for example, you have a non-physical trader that takes this position and then starts trading out across Europe. The shock still comes at the end of the interconnector.
Yeah.
So
it's just the shock is transferred towards the mainland, so to say.
Yeah. And I mean, I don't know if people are if TSOs are talking about this. I would imagine they are talking about it, but yeah, you can harmonize a lot in markets, but if you don't harmonize the little tiny details, you can still disrupt quite severely your neighbor markets.
But could you say that whenever a non-physical trader who is active on the Faraday platform supports NESO, National Grid System Operator, that shock that is transported over the interconnector towards the European mainland, that Europe as a synchronized market can absorb that shock a lot easier?
I think there should not be a problem because you have this synchronized European copper plate of frequency sort of maintaining itself. The problem becomes a bit bigger when you like drop 5 gigawatts of power in Europe or take 5 gigawatts out of Europe in one go. I mean, yeah, I think that is a flaw in the GB capacity mechanism, and I think that's one of the things. If you're looking at integrating UK back into the European power market, that's one of the things you would probably have to look at.
And then if in case the whole market is coupled and there's enough capacity available on the European mainland, it's fine. But if you're dealing with a very curtailed scenario, and I think that's what you often see, right? Severe happens when others having severe challenges as well. Then it can give quite a knock to the system.
Yeah, it's you things effects like can add up, and if you it's conceivable that you create some sort of perfect storm or perfect stillness in the continent. And yeah, I think this summer is going to be super interesting to follow. I'm not saying go long power banks and candles, but it is interesting to see how grid operators will deal with these new challenges, because I'm quite sure that 5 years ago nobody ever thought about these.
So you could argue, especially in the seat that you're sitting at, looking at specifically these markets all the time from asset perspective, also speculation perspective, that the rules and the system that we're having do have some kind of lag, that the market is just evolving faster than the rules, leading to such challenges.
Yeah, there's always, it's a term we call policy lag. So the market evolves faster than people can make rules. And when regulators or politicians create rules, there's always flaws in them. So yeah, if you let the market deal with this, it will generally solve it. If you interfere, then you'd better have a good way to back out of those regulations, similar to subsidy regimes. And so, like we've seen with solar subsidies in Netherlands, those turned out to be so positive that it's now almost impossible, or you could call it political suicide, to abolish those incentives. So it's always interesting to see how easy it is to disrupt the market and how difficult it is to restore the order.
I'm no expert on this matter, but of course, the UK being not coupled anymore, all the interconnector capacity is explicit. You see some challenges happening or ahead of us. Is there enough political cooperation and goodwill, and are all the grid codes, the handbooks, the harmonization rules, are they enough in line to take quick action between an EU and a non-EU governmental body to facilitate good cooperation on this frequency response balancing via the interconnectors?
Yeah, it all comes with political will. And so I think if you look at recent election results, it's not always sensible policy that wins you the election. Actually, on the contrary. So yeah, I imagine people are talking intensively, but in the end, yeah, it's politicians that make the decisions. So yeah, that's very difficult to predict, I would say.
And one of the things that we, of course, as time to market see a lot is just assetless traders who want to be active everywhere. Where specifically on the physical spot markets, the whole they add to intraday trading, intraday continuous trading, and the potential to have physical imbalances with purely financial settlement, and no legal consequences as such.
Yeah.
These are, of course, very, very strong drivers for all these participants to be in as many markets as possible. What do you see from your Montel seat or from the developments over the last few years on the regimes that these TSOs follow and how it supports or it withholds efficient markets?
Yeah. It's a bit of push and pull, I would say. So there's a few markets that are very liberal. So in Netherlands, you've always been able to do non-physical positions. In the UK as well, France, whereas Germany is very strict, and has always said, well, we don't want people without assets to really have imbalances, because how are they going to manage their imbalances, and how are we going to prevent the lights going out? It's a very German way to think about that. It's not properly engineered if you don't have the backup. But I think what people forget is that non-physical traders add a massive amount of liquidity to the market. And this liquidity is crucial, not just for people in speculative positions, but especially for people that don't speculate and that have risks to manage. So if you have a renewable asset, or if you have a power plant and then you have an outage, if the market's not liquid enough, then you have a serious problem, and those could be life-changing, as we call them. And yeah, I'm a big proponent of having non-physical traders being allowed to have imbalance positions. You could potentially limit what they can do if you're really afraid, and maybe like start with a very strict regime and then sort of loosen it up over time as you see it works, because it will work. These guys are like quantitative geniuses. They will not make the wrong mistake, or at least not all of them at the same time. So it adds liquidity, and it makes your market more resilient. And yeah, if you look at how the Irish market has evolved from only a couple of market participants when the new single energy market went live, to how many parties are active in Ireland now, it's massive. We see a similar thing in Hungary, for example. So a lot of market parties entering that market. Similar in Austria, which actually has limits on what you can do as a non-physical trader. But yeah, I think markets where you have a few dominant players, it's super important to have as much liquidity as possible, and not just from those 2 or 3 large players. So I think market like Portugal, Spain could benefit a lot. A market like Germany, where also you have a few very large players. France definitely is benefiting from this, and yeah, it just helps to sort of smoothen the transition and limit the amount of price shocks, which is sometimes the opposite of what you see grid operators saying. So sometimes they're saying, yeah, these guys, they come speculate, and that's why we have those price shocks. I think Poland was a nice example recently. That's not it. It's not them. It's
and this is a super interesting point. And from a qualitative perspective, logically, it makes sense. Let's say a German TSO that does not like assetless traders coming into their market. It is about grid stability, yada yada, all fair arguments. But you are also right on stating that these super smart parties with deep pockets as well. I mean, even worldwide hedge funds with billions of assets under management are entering this market with the smartest minds on the planet to, of course, make money in these markets. But that does lead, of course, if you have many of these two, efficient pricing.
Yeah.
And the question now is, with all the data at Montel, at EnAppSys, are you or have you also looked at quantitative analysis that can support your hypothesis that higher amount of assetless traders can benefit either liquidity or reduce volatility? Or is it really hard to make such a statement with the complexities of these markets?
Yeah, it's very difficult to compare markets. Well, one thing I will say is that there's very few markets that see as extreme intraday prices as Germany. There's one important reason for it. That's because the balancing market just does also go very extreme, and the TSOs are quite strict in saying you can't have this imbalance position. So people will also accept any price at some point because the risk manager watching over their shoulder and saying you have to close this position because we could lose our license. So it is it works a bit both ways. But yeah, if you would want to do this analysis properly, you would have to analyze not just the intraday market, but also the consequence of not closing your position in balancing markets. And then those regimes are so totally different from country to country that that it becomes very difficult to say something concrete about that.
And then on top, you have all the other algorithm systems as the 𝐜𝐴𝐴 and the PICASSO, of course, having their quantitative effects, which might sometimes be hard to lead to normal people's conclusions, so to say.
Not just normal people's confusion. No, it's I mean, especially PICASSO, there's definitely data missing to reconstruct the logic that's behind price formation. And that's impacting how people look at balancing markets as well. So yeah, some markets have always been like super moderate, like Italy and Poland. So if you're used to the lowest balancing price being 0 and your highest balancing price being 200 euros, maybe 400 euros, if it's very extreme, then yeah, you can just price in your imbalance in a supply contract. But it's not very, it doesn't really incentivize being balanced. So people would not actively manage their positions per se. Whereas if you are in Czech Republic with a very shallow balancing market, 250 megawatts, with a maximum price of 10,000 or 15,000 euros, you better damn well keep your position very tight and make sure you can rebalance. So yeah, and then if you get coupled to a market like that with a market that's not used to those kinds of price levels, like Poland did when it joined PICASSO, and yeah, sometimes it decouples from Germany. But then if it's only coupled to Czech Republic, you get these massive price spikes, either upward or downward. So that causes panic. And then your local rules can sort of, either mitigate the effects or make them worse. It's it's been an interesting year. Let's say that.
But this also confirms the whole complexity and the challenge of the energy market, right? There is so many different regulations, countries, players, systems in place, on top the volatility on the short term, political uncertainty on the long term. Yeah, you can't blame our society for not finding an optimal solution, right? Because there's just too many parameters all over the place affecting everything.
Yeah, we call it the bouncy castle of energy regulation. So if you press down in one spot, something else is going to pop up, and it might not be in the place you expect it to pop up. So it's it's a very funny analogy, but it does work.
Yeah, and then we could maybe even say that having just a lot of participants everywhere to absorb such price spikes might be just for the best.
Yes, and so that's definitely, to come back to the point of non-physical traders. So they are a catalyst. They have been a catalyst in many markets, and if you acknowledge that, I think anybody would sort of harmonize the way that works across Europe. That would be a brilliant lubricant, I would say, for liquidity. Absolutely.
It is, of course, very easy to say from our seats here with only looking at what we know. But wouldn't it be great for the market if there would be just full clarity and transparency written down between all the TSOs on what is and what is not allowed from a balancing point of view? What can you do day at intraday? What may you have an imbalance? What are your limits? What are your collateral requirements? What are position limits based on asset side or whatever? If all these things would be defined, wouldn't be there just many more people, let's say, supporting the system?
Yeah. I mean, things like this are defined for any mature market. And so if you look at an options market or a stock market, those kinds of rules are written down. And that's the only way you can actually internationalize markets properly. So the underlying logic either has to be super clear, or it has to be harmonized. And the problem is now that we're harmonizing parts of the market. So we're doing AFRR reserve markets with PICASSO. We're doing MFRR reserve markets with MARI. We have 𝐜𝐸MA. We have the single intraday coupling. But if in the end, the last station of where you end up with your energy portfolio, and that's balancing, if the outcomes are so different from country to country, and also the options to mitigate your risk are so different from country to country, then you can harmonize whatever you want on top, but you're going to keep a disharmonized market underneath. And it's almost like window dressing. Like, okay, look, we've got these harmonized rules. It's only the consequences that are a bit different from country to country. It's going to be an evolution. I mean, Rome wasn't built in one day, although Picasso was sort of retreated from in one day almost in Italy. But I don't see a path on a European scale to move towards that. I don't think people see or policymakers don't see the urgency.
So that is both a risk and an opportunity, of course, still for the market participants to have that unclarity in these markets.
Yes. Well, I mean, the differences are both a risk and an opportunity. And I think non-physical traders are very, very capable of choosing which is which. But of course, for the market as a whole, you'd be better off with a completely harmonized market.
And then as one of the last topics, if we look ahead, and of course we addressed some of this already, but what are, do you think, the biggest risk on the longer term? We discussed now maybe the lack of regulation on what can you do where, but what are you thinking?
Yeah, I mean, in today's world, there's no getting around geopolitics. So yeah, geopolitical risks are there, and you may see um, changes in markets that yeah, I mean, you can model whatever you want, but you can't mold the mind of a Putin or a Trump
Yeah.
or whatever. Yeah, Ayatollah may be in charge in the Hormuz Strait. So there's a lot of things going on that, yeah, from Europe we can't really influence that much. And it's very interesting how our dependencies shift. So first we were very dependent on Russian gas, and now we're starting to depend on American LNG, and we've always been dependent on Chinese assets for renewables and now for storage. Yeah, I think step one is awareness. So be aware that we are dependent, and sort of find ways of yeah, dealing with the volatility that can arise from erratic minds. Yeah, and then, I mean, zooming back in on Europe, so we're going to continue to see renewable development. I think the North Sea offshore wind plan that was presented is definitely going to produce a lot more renewable power. Yeah, are we going to see the boom in data centers? I think a few years ago we were expecting to see a boom in hydrogen production. And then it turned out to be a bit more challenging to scale that up to the scale that we thought we were going to scale it up. So I mean, yeah, I think the main challenge is to find what are the levers that we can pull as Europe, and what are the consequences, because it's never going to be nicely synchronized. We're not going to, like, put one offshore wind farm online when we've got 2 GW more of demand. That's not never going to coincide.
The
So we're always
challenges
going to,
will remain over
yeah,
the next
yeah,
years, but also over the next decades.
yes, and that makes it fun. I mean, I love efficient markets, but there's also a charm in inefficiency and trying to overcome challenges. So it's going to be interesting for a while.
And we have plenty of juice to stay in this market and enjoy all the moves, the uncertainties, and the events that are happening.
Definitely.
Jean-Paul, I would like to round up and thank you, of course, very much for all your time today. We touched upon many, many topics, and I would nearly say let's make it a recurring thing. I mean, we need to next year have another chat and hear what are your thoughts and what of the look ahead that we had today become true.
Yeah, now I have to watch my words then. But that's
Now, I
good.
would like to
That's
thank
good.
you very much for today, for being available. I would also like to just share with the audience, if you ever want to have a chat about the markets with Jean-Paul, I believe you are always open for a call. You have decades of experience on these physical short-term power markets. You are on, I could nearly say, the king's throne of data that you have with EnAppSys Montel. So please reach out to Jean-Paul if you would like to have a chat or get to know more about the products and the services that they offer. And then for today, Jean-Paul, once more, thank you very much, and I hope to see you soon again.
Very welcome.